I'm Mark Draper. Joining me is Hamish Douglas, who's the CEO of Magellan Financial Group. Today we're talking about Greece. There's been a lot of talk about potential Greek default on their loans. Hamish, can you tell us what's the difference between an uncontrolled Greek default and a controlled Greek default, and what it actually means for investors?
Well, thank you, Mark. An uncontrolled default scenario of Greece would be a scenario in which the European Union and the IMF and the ECB would not extend any further money to Greece. They've got a bond payment coming back, and if they are not extended any additional money, they wouldn't be able to pay that bond back, and they wouldn't be able to pay any government employees or anything else. It would actually result, in our view, in a spectacular implosion in Greece. Automatically, all the credit default swaps would get called in because it would actually be a default of their bonds. Their banking system is likely to collapse in that environment. Most Greek businesses who have borrowed money from offshore investors. They would not get extended any more money, and you really would have a complete collapse within Greece. And then, unfortunately, I think it would rapidly start spreading outside of Greece into other countries such as Portugal, possibly Spain, Ireland that's solvent, but it could suffer some issues, and you could get a rapidly escalating financial crisis, potentially in a much worse dimension than we saw after the collapse of Lehman Brothers. So that would be an uncontrolled default scenario. A controlled default scenario is the most probable and I think very likely outcome here. Yeah. And that Greece is insolvent. It has too much government debt to be able to service on an ongoing basis, and therefore you need a structured reduction in indebtedness via either the European Union lending money on very low interest rates, and combined with the private sector taking a write-off on their debt, mostly again probably extending loan terms and lending at subsidised rates, and that's on the table at the moment. And possibly another form would be to use the market, where the European Union could lend money to Greece, and then Greece could use that money to step into the market to buy their own bonds back on the market at 50 or 40 cents on the dollar. Yeah. That would reduce their burden of their current debt that they have, and a structured default is a default where their obligations reduce over time through these various mechanisms. We think that is a very, very probable outcome. In reality, I don't think that has a lot of consequences for the world if that's the way this plays it out. Of course, there are some banks in Europe that hold Greek bonds, and if they're having to write the value down, some of those banks may need more capital. And that is something that needs to be addressed as part of this structured default of Greece that is most likely to be the outcome.
For further updates on the Greek debt crisis, stay tuned to our website or send us an email. We're happy to provide further updates.